He's a mid-cap expert. Over the years I've interacted with him, I've always said that if not the best, he's one of the best stock picker in the mid-cap space. And it's time to get some stock pickers right now, because if this market indeed has if the bull market is not over, then this bout of correction will be looked as a great opportunity which investors should not miss on. So Nilesh, I'm going to open my WhatsApp and I have the access to your last letter. And the headline says, time to act rationally. But Nilesh, when you see portfolios drop 15, 20, 30%, come on, my friend, rationality doesn't exist. Fear takes over.
Yeah, exactly. That's how market movements are, and that's how market cycles are. I think when markets rises, stock prices rises, one tends to get irrational, and in the process also end up owning poor quality stuff. I clearly believe that clearly this is really a good time to kind of buy into quality, build a good portfolio. It's very difficult to really figure out how this market is going to play out over the next maybe 2 or 3 months. But if you kind of look at quality stocks, companies with strong managements, good balance sheets, value accretive business model, and kind of buy into these stocks with say a 2 to 3 year horizon, you could actually end up making some really outsized returns, especially when you buy into a panic situation like this. So it's easy to kind of really look at what's happened over the last 1 month, but I think one needs to kind of take a step back and look at what could potentially happen over the next 2 to 3 years. And I think that is what we kind of refer to being rational in our latest Envision Connect, which we released yesterday.
Nilesh, that's the biggest truism. Buy good companies with good management, buy them at the right price. Now, I'm not an expert like you. And in this kind of a market, let's take the liberty of talking ideas and stocks, because indeed, if you feel that the best of the bull market is yet to come, so then tell us how should one participate. It's very easy to come out and say, okay, buy good companies, hold them for 2 or 3 years. Now, that an MBA student will also tell us.
So Nikunj, I think what we have seen is that, what we've clearly seen is that 2 or 3 pockets where there's been a reasonably good shave off, and clearly now value is emerging. So if you really look at, the entire space of financials, and when I say financials, I'm not referring to NBFCs alone, but it's basically a larger category of private sector banks, life insurance companies, stock exchanges. I mean, if you really look at that entire space, and if you really look at how their prices have behaved, a lot of these stocks have corrected more than 20% over the last 1 or 2 months since their highs in December or January. And what we believe is that this is a segment which will witness one of the fastest growth rates over the next maybe 2 to 3 years. And we clearly believe that a very strong growth coupled with basically the recent price correction clearly offers investors a very, very good entry opportunity. So that's one space. And I'd probably say that in this space, look at the tier 2 names, the second level of names, because they will be able to grow faster. Obviously, of course, what you need to buy into is a quality franchise, but I think clearly the tier 2 quality franchises will grow at a faster pace across private sector banks, life insurance, exchanges, rating companies. This is the really one big segment to look out for. The second big segment to really look out for is travel and hospitality. Again, stock prices have corrected more than 20% from their highs in December, January, and look out for companies again who are leaders and are doing a very, very good job. The third big area in which I'm not quite sure if there's an immediate opportunity, but over say the next 5 years, healthcare is going to be a very, very big opportunity. Companies which run hospitals, so companies which are going to set up a chain of hospitals in tier 2, tier 3 cities of India or in semi-urban places. Clearly, if Modi Care becomes a reality, which has got proposed in this budget, and if it becomes a reality, there is serious wealth creation to be made in that space over the next 5 years. So clearly, these are some of the pockets where we see where we see opportunity as well as a long-term growth potential.
Nilesh, could you highlight the kind of return ratios you expect or hope to see from some of the hospital businesses, because they haven't quite made money for investors as of now? I mean, we know what's happening with Fortis Healthcare. Shadi Hospital, which is one of the recent listings and in the new kids on the block, I think they've managed their business fairly well in terms of keeping their debt levels in check. I think owning some of the properties and balancing out the real estate aspect of the business. But other than that, how are you looking at the profitability ratios of these businesses to change in lieu of course, there being a policy support stepping in to make these businesses viable from an investment standpoint?
Yeah, so what's really going to happen with the healthcare segment is that all the names that you kind of really refer to are kind of by and large a tier one phenomena. And when you kind of operating in some of the big cities of India, basically the real estate cost is a very huge hurdle to kind of profitability and growth. But I think what the Modi Care proposal in the budget, what it envisages is to ensure that you are going to be able to provide affordable health care on a very mass basis, where basically we're talking about 10 crore families being reached out to, and they being provided affordable health care. That means getting into tier 2, tier 3 cities, the smaller towns, the semi-urban locations, the Jilla headquarters, the district headquarters. That's the kind of place where real estate cost is a lot more affordable, a lot more reasonable. So that's one. So I think the setup costs are going to be lower. The second big advantage which some of these companies could have is the advent of REITs. So once you have some of these, the real estate investment trust or the investment trusts which come in, I think they would basically have access to capital and have access to capital at an affordable or a reasonable rate. So that's the second thing. The third, I think, is that we talk about technology more from a digital perspective, or we talk about technology from a digital transformation perspective and a consumer perspective. But I think technology is playing a very, very big role in healthcare. And I think technology is going to be a huge enabler to kind of reach out to millions of people and millions of households. And I think that will make it faster for some of these companies to really scale up. So you see these three opportunities which will help healthcare companies to kind of grow at a much faster pace and grow in a more capital efficient manner. So I think what we have seen over the last 5 or 10 years in the healthcare sector, I think over the next 5 to 10 years, you're going to see something even much more bigger, something even more profitable, and something even more capital efficient. And I think that's clearly the big opportunity there.
You're also saying that 2018 could be a comeback year for Indian IT. You're saying could be. It's not something that you have a conclusive sense on just as yet, or do you believe that no, things are moving in that direction? It's just a matter of time for the tide to change, and we've already seen that with the Q3 numbers and the environment changing in the US.
Yes, clearly IT remains a very, very attractive segment, especially the tier 2 names. That remains extremely attractive. We believe that I think we've seen growth rates bottom out for the Indian IT sector, so they've been growing in single digits. They could probably get into high single digit and maybe and then into mid teens in terms of their growth rates, which I think is going to be fantastic. Two is we're clearly seeing again margins bottom out for them. The currency has really been unfriendly in a way for the IT companies, and we actually believe that again the worst is over for IT companies in terms of their margins. And third is that last year I think a lot of IT companies have put to work their excess cash in doing buybacks, and that in a way that in a way increases the ROE for these companies. So going forward, what we could see is better revenue growth, better margins, and healthier ROEs. So clearly that in a way I think is a good signal. Of course, some of these stocks have run up quite a bit over the last maybe 2 to 3 months. But if there is again a correction and a suitable entry opportunity, we clearly believe that IT is a fantastic sector to be in, and it's a fantastic sector to bet on.
We always get into sectors and we try to go closer to what your ideas are, what you're buying and selling. But I guess the broader question, Nilesh, what I want to ask you, and I quite want to talk about it because you've made it official in your newsletter, which is that one should not worry about the bond yield spike. I guess that's a broader question. I mean, is what is happening in the bond market, could that have an impact on the equity market? And you believe it will not have an impact on the equity market. So I want to understand your thoughts here.
So what we're referring to is basically bond yields back home. And the bond yields back home have probably spiked up by maybe 75 basis points over the last 6 to 9 months. We clearly believe that if you look at the bond yields in India over the last maybe 10 years, they've broadly moved in a range, and at approximately around the 7.5%, they're really over towards the top end of this range. So we clearly believe that there is really no strong case for bond yields in India to kind of spike up beyond this range that we have seen for many years. So we clearly believe that the worst is over in terms of the spike in bond yields, number one. Number two, in India, a 75 basis point spike in bond yields really doesn't make investors change their asset allocation plans. Clearly the opportunity in equities is much bigger, and a 75 points swing doesn't really make matters worse, or it doesn't make investors to kind of change their asset allocation plans, and therefore we really don't see an impact of that on domestic equity flows. So that's the second thing. Third is when we talk about bond yields globally, at least in the very near term, we really don't see, I mean, there's really already a concern that bond yields could spike above 3%, and if they cross 3%, that's going to be a doomsday scenario. I think that kind of a scenario still is very distant, and I think it's only remotely possible because clearly everybody is betting on a spike in inflation. So we don't really think that inflation is set for a huge spike globally. People are betting on crude oil prices to remain elevated for a very long period of time and cross that hurdle of $70. But if you really look at it globally, there is really no strong fundamental case for crude oil prices to kind of cross $70 and remain there at that range of $80-90. We probably believe that again crude oil prices are also hovering around that top end of the range which they could potentially be at. So we clearly believe that from this perspective, we don't see all of these factors having a material impact on equity markets in India.
Nilesh, now let's be clear here. This is a sell-off, or this is a technical adjustment which has happened because of global growth. It's not because of global growth scare. It is because of an inflation scare. Now, why should investors be worried about an inflation scare? You know, global growth is not like fantastic, and locally we are struggling for growth. So, growth coming back should be great news. And right now markets are behaving that growth coming back is bad news. And if indeed growth is making a comeback, then is there money to be made in commodities? You don't like commodities, I know that. But in the short term, if you have to academically discuss the way for commodities and names like Tata Steel and Vedanta, what they could do, is there money to be made in some of the metal stocks?
Well, purely from a very trading or a momentum point of view, there could be some money which one can make, in the very short term. But if you really look at it, I mean, we've been talking about commodities now for such a long time in terms of the commodity prices, the end prices kind of spiking up and all that. But if you really look at some of these stocks, I don't think these stocks have got anywhere over the last 1 or 2 quarters. Look at it. I mean, at the peak of these commodity prices, I mean, when I'm saying peak, I'm referring to the peak over the last maybe couple of years. These companies' profits are not growing by leaps and bounds. I mean, still their profits are growing in the broad band of 10 to 15%. They're all talking about cost pressures. So we have to keep this aspect in mind, that clearly there is a lot of noise about commodity prices spiking up, but it is not translating into some really solid operational and financial performance of some of these underlying companies like the names you mentioned, and these are all leaders. So I would wonder that if tomorrow, if some of these commodity prices were to be up by 5-10%, what would actually be the operational and financial performance of some of these commodity producers or commodity converters? So I'd clearly again say that yes, there could be some money which is there on the table from a short-term trading point of view, but clearly believe that over the medium term, I don't think there is really enough returns or enough wealth to be made by investing in some of these commodity producers or commodity stocks. Of course, there could be some of those very lone exceptions to this, but in general, I don't think that's a great place to be in.
Nilesh, it's great to have you on the show. Thanks very much for taking out the time to share with us your thoughts and give our viewers some insights on your investment ideas.